welcome to today's EdgeShort. In this episode, we'll explore a crucial aspect of futures trading, understanding the expiration of futures contracts and the process of rolling them over. Let's talk a little bit about the lifespan of a futures contract. Every futures contract has a predetermined lifespan, hence future, ending on its expiration date, sometimes called the last trade day or last day. This expiration date marks the last day you can trade that specific contract before it enters its final settlement. When approaching settlement, some contracts will become very thinly traded or liquid. So understanding your options as the contract approaches expiration is key. As the expiration date nears, you essentially have three choices. The first option is to offset the position. This is the most straightforward approach, and you offset or liquidate your open position. Offsetting involves executing an opposite and equal trade to your original position, effectively closing it out. By doing so, you can lock in any profits or losses without the need to take physical or cash-settled delivery of the underlying asset. This is one of the more common methods traders use to exit a position ahead of expiration. Another option is to roll over the position. Rollover, and I'm not talking about rolling your charts over the actual position, is the process of using a spread to close your position in the expiring contract while opening a position on a contract with a later expiration date. This is a common strategy for traders who want to maintain their market exposure without interruption. The timing of a rollover is often dictated by the market volume on each leg of the contract and the price difference or spread between the months the trader is looking to roll from and to. Many traders choose to roll their positions when the next month's contract begins to see higher trading volumes and trading activity than the current one. This ensures liquidity and smooths the transition to the new contract. Lastly, let's talk about settlement. If you don't offset or roll your position, the contract will expire and go into settlement. Depending on the type of contract, settlement could involve physical delivery of the underlying asset, such as barrels of crude oil or bushels of wheat, or your product could be cash settled, with the financial profits or losses determined by the specific settlement price provided by the exchange. If you are unsure of how the settlement price is determined for your specific product, I would encourage you to ask your broker or visit the exchange's website for full details. Taking delivery is an option for traders, and it's utilized for certain groups such as hedgers, but it requires a clear understanding of the contracts, the size, the terms, and making sure that your broker and FCM have the resources to handle delivery or receipt of the underlying asset. So why does this matter? Understanding your options as a futures contract approaches expiration is important for all traders. Whether you choose to offset, roll, or settle, each decision can impact your trading outcomes and risk management. Rolling your position allows you to maintain market exposure, while offsetting can lock in gains or limit losses for that current contract. At EdgeClear, we're dedicated to supporting your trading journey every step of the way. Our team is always ready to assist with any questions or insights you might need regarding rollover, contract expiration, and managing your positions. Thanks for tuning in today. Stay informed, plan your trades wisely, and as always, happy trading.